Introduction. Have you ever felt like the market is always one step ahead of you? Like no matter how many YouTube videos you watch, how many indicators you add, or how many hours you stare at charts, you still end up frustrated, confused, and losing? You're not alone. Most traders don't fail because they lack information. They fail because they never learn how to think like a trader. They chase signals instead of building systems. They react with emotions instead of executing with discipline. They trade to win today instead of learning how to survive and grow long-term. This book isn't about the next hot strategy. It's about becoming the kind of person who can consistently win by thinking smarter, managing risk better, and mastering the inner game. Whether you're just starting out or you've been trading for years, the smart trader will help you break the cycle of impulsive decisions and inconsistent results, and finally become the trader you know you're capable of being. Let's stop guessing. Let's start thinking. Let's become a smart trader.
Chapter 1. Stop trading. Start thinking. Have you ever caught yourself placing a trade based on a gut feeling? Maybe you saw a sudden move and didn't want to miss out. Or maybe you were down for the day and just wanted to make it all back in one shot. If so, welcome to the club. That's how 90% of traders operate, and that's also why 90% of traders lose. This chapter is about breaking that cycle, because until you learn how to think like a trader, not just act like one, nothing will change. It doesn't matter how fancy your setup looks, how many monitors you use, or how many courses you've bought. The market doesn't reward activity. It rewards intelligent decision-making. When I started trading over 20 years ago, I thought it was all about predicting the next move. If I could just figure out what the market was going to do next, I could make money. I believed trading was about being right, and that belief cost me tens of thousands of dollars in losses, months of emotional stress, and countless nights staring at screens wondering what I was doing wrong. What I didn't realize was this. Trading is not about being right. It's about making good decisions over time. This one shift from trying to win individual trades to focusing on making smart decisions repeatedly changed my entire career. That's what this chapter is all about, because you can't become a smart trader until you stop approaching trading like a guessing game and start thinking like a strategist. Let's start by facing a hard truth. Most people approach trading like gambling. They may not admit it, but that's what it is. They see the flashing candles, they feel the rush, they bet based on emotion, and then they pray. They're not trading with a plan, they're reacting. They're trying to outguess the market. But here's the thing. You don't need to predict the market to make money. You only need to react intelligently. Smart trading begins with understanding that the market is a game of probabilities, not certainties. No indicator, no mentor, no strategy can give you 100% accuracy, and that's okay. You don't need to be right every time to be profitable. You need to stop treating trading like a series of coin tosses and start treating it like a business. That means thinking in odds. Think of yourself like a casino, not the gambler sitting at the slot machine. Casinos don't care about individual outcomes. They know that over hundreds or thousands of plays, their edge will play out. That's how smart traders operate too. We don't trade for today. We trade with the long game in mind. Here's where most beginners go wrong. They place trades based on emotion, fear, greed, revenge, hope. But emotions aren't signals, they're noise. Smart traders learn to separate the noise from the signal, and that begins by building a mental filter. What does that mean in practice? It means before every trade, you ask yourself, is this decision based on a system or based on how I feel right now? Most of the time, if we're honest, it's the latter. We see something moving, we feel like we're missing out, or we're trying to make it all back in one shot. A smart trader thinks differently. They pause, they plan. They know their criteria in advance. They're not trying to guess the outcome, they're trying to execute a plan consistently and with discipline. Let's talk about the mental shift from gambler to strategist. A gambler looks at the market and sees opportunity everywhere. Every breakout looks juicy, every pullback looks like an entry. They feel the need to be in the trade to feel alive. They trade because they want action. A strategist, on the other hand, sees the same chart but asks, what is the context here? What's the probability this setup plays out the way I want? And what's the risk if it doesn't? And does this trade fit my edge? That's the key word here, edge. Every smart trader operates with an edge, a defined set of rules or setups that over time give them a higher probability of success. Without an edge, you're just flipping a coin. But here's the twist. Having an edge isn't enough. You also need the mental discipline to only trade when your edge is present. That's where most people fail. They either don't have an edge or they trade outside of it because they feel bored or emotional. Smart traders don't just find an edge, they protect it. There's also another mindset that separates smart traders from the rest. They trade for consistency, not excitement. Think about this. Most people come into trading looking for freedom, financial, time, life freedom. But then they fall into a cycle of emotional chaos. They win big, lose big, and repeat. Their entire life becomes a roller coaster. That's not freedom, that's a prison. A smart trader wants boring, predictable, repeatable. They don't chase dopamine, they chase systems. That's why they survive while others burn out. Here's a lesson it took me years to learn. You don't get paid for trading more. You get paid for thinking better. Let that sink in. More trades does not equal more profit. In fact, the more you trade, the more chances you have to make mistakes, especially emotional ones. Smart traders don't try to be in the market all the time. They wait for high-quality setups. They don't trade out of boredom or FOMO. They wait for alignment between the setup, the risk, and their plan. This is the thinking side of trading. It's not about predicting the future. It's about managing the present with clarity. Let's talk about one of the most powerful mental tools a smart trader uses, thinking in probabilities. Thinking in probabilities means you understand that any one trade is irrelevant. It doesn't matter if your next trade is a win or a loss because you're playing a larger game. Just like a poker player doesn't go all in on every hand, a smart trader doesn't risk everything on one setup. They understand this trade might lose, and that's okay, because over 100 trades, my edge will work. This mindset removes emotional attachment from single trades. No more panic, no more obsession, just execution. Another key piece to smart trading is self-awareness. You must become the observer of your own mind. Smart traders ask, am I calm right now? Am I focused? Am I trying to force a setup? Am I trading to win or trading to feel better about a loss? They recognize their triggers, boredom, revenge, greed, insecurity. They journal their thoughts. They watch their patterns. They do the hard inner work. Because trading is 80% mental. You could give the same strategy to 10 traders and only 2 would be profitable. Not because the strategy is broken, but because the mindset behind the execution isn't strong enough. So if you want to trade smart, start by training your mind. That's your real edge. Not the setup, not the strategy, your mind. I want to share a turning point from my own journey. After a brutal losing streak early in my career, I took a month off and reviewed every trade that I had taken in the past 6 months. I printed charts, wrote notes, and tracked emotions. What I found was painful but freeing. Most of my losses weren't strategy failures, they were mental failures. I was entering too early, exiting too late, adding to losers, chasing highs, and skipping stop losses. And all of it came from one problem. I was reacting instead of thinking. So I made a rule. I wouldn't place a single trade without answering 3 questions. What's the setup and does it fit my edge? What's the risk to reward ratio? And am I trading with emotion or logic right now? That simple checklist helped me pause, breathe, and think. It saved me from countless bad trades. It wasn't perfect, but it was a start. And that's where smart trading begins. Not with perfection, but with awareness. Let's wrap this chapter with a message that could change your life. The quality of your trades will never exceed the quality of your thinking. So if you want better results, don't look for a new indicator. Look inside. Clean up your mindset, build a process, start thinking like a strategist. Let go of the need to always be right. Let go of the fear of missing out. Let go of revenge, overtrading, and chasing. Instead, embrace clarity, embrace patience, embrace discipline. Because when you stop trading like everyone else and start thinking like a smart trader, everything changes.
Chapter 2. The market doesn't care about you. You place a trade. Your setup looks perfect. You've done your analysis. Everything aligns. And then the market moves against you. Fast. It hits your stop. You feel frustrated, confused, maybe even betrayed. How could this happen? The setup was perfect. Let me break something to you early. And if you truly absorb this, it can save you years of pain and thousands of dollars. The market doesn't care. Not about you, not about your strategy, not about your emotions. It's not out to get you, but it's not here to save you either. The market is neutral. It just is. This is one of the hardest truths for traders to accept, but it's also the most freeing once you do. Most new traders take losses personally. They think the market is punishing them, or they get obsessed with getting back at the market after a bad day. It's easy to fall into the trap of believing that the market is a living thing, an opponent that's trying to outsmart you, humiliate you, or test your willpower. But the market doesn't know you exist. It's not your enemy. It's not your friend. It's not fair or unfair. It doesn't owe you anything. The sooner you accept this, the sooner you start trading like a professional, with clarity, objectivity, and detachment. Let's talk about attachment. Most traders come to the charts with emotional baggage. They're attached to being right, attached to recovering losses, attached to their predictions. And that attachment clouds everything. If you're attached to an outcome, your decision-making becomes biased. You'll hold on to losers longer than you should. You'll cut winners short out of fear. You'll ignore warning signs because you want the trade to work out. But the market rewards those who respond, not those who hope. It doesn't care about your expectations. It only reflects supply and demand, collective psychology, and cold, hard data. When you internalize this, something shifts. You stop begging the market to validate you. You stop trading for emotional comfort. You start seeing the market as it is, not as you wish it to be. That's when real progress begins. Let's get even deeper. There's a dangerous mindset that kills traders, the belief that you are the center of the market. You think, I did my homework, so the market should reward me. I lost 3 trades in a row, so I'm due for a win. This setup worked last time, it has to work again. Do you hear the flaw in that thinking? It's all centered on you. But the market doesn't know you exist. It doesn't know your strategy, your past trades, or your hopes. It moves based on the actions of millions of participants, from hedge funds to bots to retail traders. It reacts to macro events, economic data, central bank decisions, earnings, and global sentiment. You are a tiny ripple in a vast ocean. And when you accept that, you stop trying to fight the waves, and you start learning how to ride them. Let me share a story. Early in my career, I had a hot streak. I won 8 trades in a row. I thought I was invincible. I started increasing my position size, taking more trades, loosening my stops. I had convinced myself that I understood the market. Then came a series of losses, big ones. I gave back all my profits and then some. I was angry. I thought the market was punishing me. I entered revenge trades. I forced setups. I blew up my account. What I didn't realize at the time was this. The market wasn't punishing me. It just didn't care. It wasn't personal. It wasn't emotional. I was the one bringing emotion to the table. That experience taught me one of the most valuable lessons of my trading career. Your ego has no place in the market. Let's talk about ego. Ego shows up when you can't admit you're wrong, when you stay in a bad trade longer than you should because it has to turn around, when you add to a losing position because you want to prove you're right, when you double down on a bad day trying to fix it before the market closes. Ego is what turns a small mistake into a massive loss. Smart traders are not emotionally attached to being right. They're obsessed with making good decisions.
And that means cutting a loser quickly, even if it hurts. It means accepting that you misread the market, and that's okay. It means knowing that one trade doesn't define your worth, your intelligence, or your identity. When you remove ego, you remove pressure. You stop trying to predict everything, and you start managing risk. You stop needing to be right, and you start focusing on being effective. This detachment is not weakness, it's power. Now let's talk about revenge trading, one of the most destructive habits in this game. You take a loss. It stings. You want to get it back fast. So you enter a new trade, not because it's a great setup, but because you're mad. You want redemption. You want to punish the market the way it hurt you. This is pure emotion, and it's poison. I've seen traders ruin entire months of progress in one afternoon because they couldn't walk away after a bad trade. I've done it myself. You go from, I just want to recover this loss, to, I just want to break even for the day, to, I can't believe I lost my entire week in 1 hour. Revenge trading happens when you forget that the market is neutral, when you start treating it like an opponent in a boxing match. But trading isn't a fight, it's a series of decisions. And when you're emotionally compromised, your decision quality drops fast. The solution? Walk away. Take a break. Reset. Review your journal. Get grounded. Let the emotion pass before you re-enter the arena. Smart traders know this rule. When emotions are high, logic is low. You can't see the market clearly when your mind is clouded by anger, fear, or desperation. That's why detachment isn't just a nice idea, it's a survival skill. The best traders I know don't get overly excited about wins or overly crushed by losses. They stay steady, neutral, focused. They don't need the market to make them feel good. They already feel good because they're aligned with their process. This emotional neutrality is one of the greatest strengths a trader can develop. It doesn't mean you don't care. It means you care about the right things: your discipline, your edge, your risk, your growth. Let's explore another dangerous emotional trap: hope. Hope has no place in your trading decisions. You enter a trade. It goes against you. Your stop is approaching, but instead of following your plan, you start hoping. Maybe it'll bounce. Maybe I should give it a little more room. Maybe the market will reverse. This is how accounts die, not with a bang, but with a slow series of hopeful decisions. Hope is a subtle but deadly emotion. It convinces you to ignore your plan. It blinds you to risk. It whispers sweet lies that cost you everything. A smart trader doesn't hope. They plan. They observe. They respond. And they always protect their capital. Here's a question I want you to start asking yourself before every trade. Am I trading what I see or what I feel? If you're trading based on what you feel, you're reacting. If you're trading based on what you see, clearly, objectively, according to your system, then you're responding. There's a huge difference between reacting and responding. Reacting is emotional. It's fast, impulsive, and usually reckless. Responding is thoughtful. It's grounded in logic, process, and awareness. Smart traders learn how to pause. They don't chase every move. They don't get seduced by shiny setups. They wait. They think. They align their actions with their edge. That pause, even just a few seconds, can be the difference between a good trade and a disaster. Let me share one more story. I once mentored a trader who kept blowing up accounts. He was smart, talented, and technically skilled, but emotionally unstable. Every time he lost, he panicked. Every time he won, he got cocky. His trading wasn't bad, his thinking was. We worked on one concept for 30 days: emotional neutrality. Every morning, he journaled his mindset. Every trade had to be rated on emotional discipline, not just profit or loss. If he felt triggered, he had to walk away for 15 minutes. No exceptions. After 30 days, his trading didn't just improve, his entire life did. He became calmer, clearer, and more focused. He wasn't trading for validation anymore. He was trading with awareness. He told me the biggest change wasn't in my strategy, it was in my attitude. That's the goal. Not perfection, progress. Not prediction, preparation. Not control over the market, control over yourself. So here's your takeaway from this chapter. The market doesn't care about you. But that's not a bad thing. It's a gift. Because once you realize the market is neutral, you stop trying to make it love you, impress it, or beat it. You start focusing on what you can control, your actions, your mindset, your risk. You stop trading to prove something, you start trading to execute well. That's how you become a smart trader. You detach from ego. You ignore the noise. You see the market clearly, and most importantly, you respond, not react. Because at the end of the day, it's not about the market. It's about how you show up in front of it.
Chapter 3. Systems beat feelings. You wake up, look at the charts, and feel a little unsure. Prices are moving, things look promising, but you're not quite certain. You check Twitter. Some traders are bullish, others bearish. You scroll, refresh, maybe change your mind a few times. You open your platform, your heart's racing, and then, boom, you jump into a trade. A few minutes later, you're staring at a red number and wondering why this keeps happening. This is what chaos looks like in trading, and most traders live inside it every single day. What if I told you that you could eliminate 80% of your stress, confusion, and bad trades just by doing one thing? Build a system. Because here's the truth that separates amateurs from professionals. Feelings are temporary. Systems are stable. When most people think of trading, they imagine action, fast decisions, instincts, and quick reactions. And Hollywood loves to sell that version of the story. But in real life, the most consistent traders are actually the most boring. They're not thrill seekers or gamblers. They're process-driven thinkers. They trade with systems, and they repeat that system over and over, regardless of how they feel. Why? Because systems protect you from your worst enemy, yourself. Every trader has emotions. Every trader feels fear, greed, boredom, FOMO, frustration. That's normal. But the traders who win long-term are the ones who don't act on those emotions. Instead, they act on a plan, a predefined, rules-based process that takes the guesswork out of trading. And that's what this chapter is about. How to build a system that beats your feelings. Let's start by defining what a trading system actually is. It's not just an entry signal. It's not just a moving average crossover or a candlestick pattern. A real trading system is a complete process that tells you when to enter, when to exit, how much to risk, and under what conditions you should be trading in the first place. It's a repeatable set of rules that creates consistency. It's your anchor in a sea of emotional temptation. Here's what a smart trading system includes: your setup, when and why you enter, your risk, how much you're willing to lose, your target, where you'll take profit, your filters, what must be true before you even consider entering, and your exit rules, when and why you'll get out, win or lose. Now, every successful trader has a unique system, because it's not about copying someone else's method. It's about finding something that fits your personality, your time frame, your capital, and your strengths. And most importantly, it's about testing that system until it proves it has an edge. Let's pause here for a moment, because this is where most traders go wrong. They think they have a system. They've read about a setup on YouTube. They've seen a strategy posted on Twitter. They try it for a few days, then it stops working, or they take a loss, and they ditch it. They jump to the next thing. New indicator, new time frame, new guru. This cycle is called system hopping, and it's a one-way ticket to confusion and failure. Here's what smart traders do instead.
They pick one approach. They test it. They track the data. They refine the rules. And, most importantly, they stick to it, even during drawdowns. Because every system has losing streaks. Every edge goes through tough patches. But you'll never know if a strategy actually works unless you give it enough time, data, and discipline to prove itself. Let me give you a real example. In my 5th year of trading, I was still inconsistent. I knew a lot of technical stuff. I could read charts. I had flashes of brilliance, but I had no consistency. One day I'd make $1,000. The next I'd give it all back. My P&L looked like a heartbeat monitor. Up, down, and emotionally exhausting. Then I did something radical. I stopped trading. For 30 days, I didn't take a single live trade. Instead, I built a system. I went back and studied my last 200 trades. I looked at what worked, what failed, what patterns had the best outcomes, and what conditions I was ignoring. I found a core setup, simple, high probability, and aligned with my style. Then I wrote down the rules. Clear, objective, non-negotiable. After that, I spent 2 more weeks backtesting that setup over 2 years of historical data. I journaled every trade. I looked at the win rate, average win, average loss, drawdowns, risk-to-reward ratio. By the end of that month, I had a system with a 52% win rate, 1.7 R average reward, and solid data behind it. I felt in control, not because I had a magic strategy, but because I had a process. That system changed everything. Backtesting is the key to confidence. Most traders lose confidence because they don't really know if what they're doing works. They're trading blind, hoping for the best. But when you've tested your system across hundreds of trades, you stop guessing. You know what to expect. You trust the numbers. Backtesting is not about curve fitting or finding perfection. It's about answering one simple question. Does this setup give me an edge over time? You don't need a 90% win rate. You don't need the holy grail. You just need a repeatable process that gives you a positive expectancy when executed with discipline. And here's something most people overlook. Backtesting doesn't just build your system. It builds your belief in that system. And that belief is what helps you stick to it when the emotions kick in. Let's talk about journaling. Every smart trader I know keeps a trading journal. Why? Because your journal is your mirror. It shows you patterns that your emotions want to ignore. It exposes habits, mistakes, and blind spots, and it helps you evolve. In your journal, you should track every trade. Entry, exit, reason, outcome, emotion, and lesson. Over time, you'll start to see what's working and what's hurting you. You'll spot your emotional triggers. You'll notice your revenge trades, your FOMO trades, your fear exits. And with that awareness, you'll start trading smarter. Not by adding more indicators, but by removing the behaviors that sabotage your results. Let's also talk about trading rules. These are your personal commandments that guide your system and protect your discipline. For example, I never trade without a stop loss. I never trade news events. I don't add to losing positions. I only trade between 9:30 a.m. and 11 a.m., and I stop for the day after 2 consecutive losses. These aren't random. They're rules designed to protect your edge and your mindset, because trading isn't just about winning. It's about not losing stupidly. Smart traders are like pilots. They follow a checklist before every flight. They don't rely on feelings. They rely on systems. That's how they avoid crashes. Now, let's address something that most people never talk about: boredom. Once you build a system and stick to it, trading becomes, well, kind of boring. There's no rush, no thrill, no drama. And that's a good thing, because consistency is boring. Success is boring. Professionals are boring. They don't trade for fun. They trade for results. And they're okay with waiting, missing moves, sitting in cash, or walking away when the market doesn't align with their setup. They don't need action. They need alignment. So if your system feels boring, that might actually be a sign you're doing something right. Let's talk about the mental clarity that systems create. Once you have a system, you no longer need to guess. You no longer wake up and wonder, should I trade today? You no longer stare at charts for hours hoping something jumps out. You know your setup, you know your conditions, you know when to trade and when to walk away. This reduces decision fatigue. It protects your energy. It frees your brain from constant noise, and it allows you to operate with precision. You become more than a trader. You become a professional operator of your process. And in a world of chaos, that clarity is your edge. Now, let's talk about trust. A system only works if you trust it, and trust is built through experience, repetition, and data. In the beginning, it's tempting to override your system. You see a setup forming that looks even better than your normal ones, or you get anxious and close a trade early, or you widen your stop because you really believe in this one. That's how traders sabotage their system, by thinking they're smarter than it. But here's the truth. You created the system when you were calm, so don't override it when you're emotional. Trust your process. Let the edge play out. Respect the data. That's what separates smart traders from erratic ones. Let me share one final story. I once knew a trader who made over $500,000 in 18 months using a simple momentum strategy. He followed his system like a machine: precise entries, strict risk management, no emotion. But after a while, he got bored. He thought,
Chapter 4. Risk like a pro. When I first started trading, like most beginners, my mind was obsessed with profits. I would read about incredible trades where someone turned $1,000 into $10,000 in a matter of weeks. I was drawn to the excitement of big wins and the possibility of fast money. My focus was on how much I could make, how quickly I could grow my account, and the thrill of watching my equity curve shoot upwards. It took years and painful lessons to realize that this mindset is exactly what kills most traders. Profits are important, of course, but the key to lasting success in trading is not about chasing profits, it's about managing risk. Because if you don't control your downside, the upside doesn't matter. One bad trade can wipe out months or even years of gains. This chapter is dedicated to the foundation of smart trading: risk management. Here you will learn how to think about risk the right way, how to size your positions correctly, how to set your stops and targets, and most importantly, how to survive the inevitable losing streaks. Master this, and you'll stay in the game long enough to win. First, let's change the way you think about risk. Most traders think in terms of dollar amounts or raw profits. I want to make $500 this trade, or I can't lose more than $200. But smart traders think in terms of percentages of their total account. Why? Because your trading account size is your capital, your fuel, your ability to keep trading. If you risk too much on one trade, a single loss can damage your entire account, maybe even wipe it out. But if you risk a small fixed percentage each trade, you protect yourself from catastrophic losses. This is called position sizing, the art of determining how much you risk on each trade relative to your account size. Let's take a simple example. Say you have a $10,000 trading account. If you risk 1% on any given trade, that means your maximum loss on that trade is $100. If the trade hits your stop loss, you only lose $100, a small fraction of your capital. Even if you lose 10 trades in a row, your account will only be down about 10% and you still have plenty of fuel to continue trading. But if you risk 10% per trade, that $10,000 account could lose $1,000 on one bad trade. Lose 3 trades in a row and you're down 30%, and that's much harder to recover from. The beauty of thinking in percentages is that your risk scales with your account size. When you grow, your risk amount grows. When you shrink,
it shrinks, protecting you when times get tough. The next piece of the puzzle is stop-loss placement. Every smart trader knows that a trade without a stop-loss is a gamble, not a trade. A stop-loss is your insurance policy. It defines the maximum amount you are willing to lose before admitting you are wrong. But stops aren't just random points. They must be placed strategically at levels that make sense with the market structure, your system, and your time frame. For example, placing a stop just beyond a recent swing low or high, or just outside a key support or resistance level. If your stop is too tight, you risk getting stopped out on normal price fluctuations, the noise. If your stop is too wide, you risk losing too much on one trade. It's a balance. The key is that your stop placement should align with your position size to keep your total risk within your comfort zone, usually 1 to 2% of your account per trade. Now let's talk about risk to reward ratio, one of the most misunderstood concepts in trading. Simply put, this is the ratio of how much you stand to gain versus how much you risk on a trade. For example, if you risk $100 on a trade, your stop loss, and your profit target is $300, your risk to reward ratio is 1 to 3. Smart traders focus on setups that have a positive risk to reward ratio, ideally at least 1 to 2 or 1 to 3. Why? Because even if you only win 40 to 50% of your trades, the larger wins compared to the smaller losses will keep you profitable. Many beginners chase setups with tight stops and tiny profits, or they enter trades with poor risk-reward where their losses outweigh their gains over time. But smart traders look for trades where the reward significantly exceeds the risk. Surviving losing streaks is the true test of risk management. No matter how good your system is, you will lose sometimes. Losing streaks are inevitable. The market is unpredictable, and even the best traders have drawdowns. If you risk too much on each trade, a losing streak can destroy your account quickly. But if you risk small, consistent amounts, you can weather storms and stay in the game. Think of trading like a marathon, not a sprint. It's about pacing yourself, managing your energy, capital, and staying on course. When you manage risk like a pro, losing trades don't crush your confidence or your account. They become just part of the process, like a basketball player missing a few shots during a game but continuing to play smart. Another important concept is scaling position size based on your confidence or market conditions. Some traders think they should always risk the same amount on every trade. That's not wrong, but smart traders adapt. If the market is volatile or if your setup is less certain, you might reduce your position size to lower risk. On days when you see stronger signals or higher probability setups, you might increase it slightly, but never beyond your maximum risk limit. This flexibility helps you avoid blowing up your account in tough times and capitalize on favorable conditions without reckless risk. Let's talk about trade sizing in relation to stop-loss distance. If your stop-loss is far away, meaning the price could move more against you before the stop is hit, you should reduce your position size so that your dollar risk remains within your target percentage. Conversely, if your stop-loss is tight, close to your entry, you can increase your position size a bit since your risk per share or contract is smaller. This approach keeps your total risk consistent regardless of the setup, which is key to controlling losses and smoothing your equity curve. Now consider the psychological benefits of good risk management. When you know exactly how much you can lose on a trade and you've sized accordingly, your mind feels calm. You're not panicking over every tick. You can focus on your plan, execute trades with confidence, and avoid emotional decisions like moving stops or closing trades early. This mental clarity is a huge edge because the markets constantly test your nerves. Managing risk well builds mental resilience and reduces stress. There's also the crucial idea of risk per day or risk per week limits. Many professional traders set a daily or weekly maximum loss. For example, they might decide to stop trading for the day if they lose 3% of their account or for the week after a 6% drawdown. Why? Because even the best risk controls can't protect you from emotional mistakes. When you're frustrated or desperate after losses, you might abandon your system or take reckless trades. Having a stop loss for your trading activity, not just individual trades, protects you from spiraling out of control. It's a simple but powerful rule that keeps your account and sanity intact. Let's also address the danger of over-leveraging. Leverage allows you to control a large position with a small amount of capital. While leverage can amplify profits, it can also amplify losses, often faster than you expect. Many traders get excited by the idea of leverage, thinking it will help them make big money. But what it often does is turn small mistakes into big losses. Smart traders use leverage sparingly and always in conjunction with sound risk management. Remember, leverage is a double-edged sword. Use it wisely, or you risk losing your entire account in one bad move. A story from my trading career illustrates this perfectly. Early on, I was overconfident. I used too much leverage and chased profits. One day, the market moved sharply against me overnight. My losses were magnified. I lost nearly 50% of my account in a few hours. It was a brutal wake-up call. After that, I adopted strict rules about leverage and position sizing. I never risk more than 2% on any trade, and I use leverage conservatively. This discipline saved me from blowing up multiple times. Let's talk about expectancy, the math behind risk management. Expectancy is the average amount you can expect to make or lose per trade based on your win rate and risk-to-reward ratio. For example, if your win rate is 50% and your average reward is twice your risk, a risk-to-reward ratio of 1 to 2, your expectancy is positive. You expect to make money over time. But if your reward is smaller than your risk, or your win rate is very low, your expectancy is negative, meaning you will lose money long term. Understanding expectancy helps you avoid hope trading. It forces you to trade only setups where the numbers work in your favor. Another advanced risk concept is the Kelly criterion, a formula used to determine optimal bet size based on your edge and win rate. While the Kelly criterion can help you maximize growth, it also recommends aggressive position sizing, which can lead to significant drawdowns. Most smart traders use a fractional Kelly, meaning they risk only a fraction of what Kelly suggests to balance growth and risk. The takeaway here is never risk blindly. Calculate your risk based on your strategy's historical performance and your personal risk tolerance. Finally, risk management is not just about surviving, it's about thriving. When you protect your capital, you keep the option to trade tomorrow, next week, and next year. When you manage risk, you give yourself the time to learn, adapt, and grow your edge. The markets are unpredictable, but your risk management doesn't have to be. To sum up, risk management.
Chapter 5. Master the Inner Game. If you've made it this far in your trading journey, you probably already understand the nuts and bolts of strategy, risk, and market mechanics. You've learned the importance of systems over feelings and how to manage risk like a pro. But now comes the most critical part, the inner game of trading. Trading isn't just about charts and numbers. The biggest battles you'll face aren't on the screen, they're inside your mind. Your thoughts, emotions, beliefs, and habits will determine whether you succeed or fail, far more than any indicator or pattern ever will. Mastering the inner game is what separates the casual trader from the professional. It's what turns good strategies into consistent profits and occasional wins into lifelong success. This chapter dives deep into the psychology of trading, how to handle fear, control your self-talk, avoid overconfidence, and build the discipline that turns a trader into a champion. We'll explore practical mental frameworks, journaling habits, and mental conditioning exercises to build a trader's mindset that lasts. The first truth you need to accept is this: trading will expose your weaknesses. No matter how hard you try to hide or ignore them, your emotions will come knocking. Fear, greed, impatience, frustration, they're all part of the package. Imagine trading like looking in a mirror that doesn't just reflect your face, but your inner emotional state. When you win, it shows confidence. When you lose, it reveals anxiety. When you're uncertain, it exposes doubt.
The market doesn't care about your feelings, but your feelings will often control your actions. And that's why mastering your mindset is more important than mastering any chart pattern ever will. Let's talk about fear. Fear is one of the most powerful emotions a trader faces. Fear of losing money, fear of missing out, fear of being wrong. It's natural to want to avoid pain, but fear can paralyze you or make you do foolish things. Fear can make you hesitate to pull the trigger on a great setup. It can make you close winners early or hold losers too long. It can make you avoid trading altogether, stuck in analysis paralysis. The key is not to eliminate fear. It's impossible to trade without it. Instead, the goal is to manage fear so it doesn't manage you. One practical way to do this is by creating rules and routines that you trust. When your plan is solid and your risk is controlled, you can trade despite fear because you know you're following a tested process. That knowledge acts like a safety net. Another big enemy is overconfidence. Winning streaks can make you feel invincible. Suddenly, you start believing you can't lose. You take bigger risks, ignore your stops, and chase trades. Overconfidence often leads to disaster. It blinds you to risks, clouds judgment, and makes you reckless. The balance is delicate. You want confidence, but not arrogance. Confidence comes from trust in your system and your preparation. Arrogance comes from ignoring feedback and acting like you're above the rules. Smart traders check their ego at the door. They approach every trade with humility, knowing the market can humble even the best. Now let's get into self-talk, the conversation you have with yourself in your mind every second of the trading day. Self-talk can be your greatest ally or your worst enemy. If your inner voice says, "I'm a loser," or "I always mess up," then your behavior will align with those beliefs. You'll sabotage your trades, make impulsive decisions, or avoid action altogether. On the flip side, if your self-talk says, "I'm prepared, I follow my plan, losses are part of the game," you'll trade with calm and confidence. Changing self-talk isn't about pretending or positive thinking fluff. It's about rewiring your mind with truthful, empowering statements that build resilience. For example, after a loss, instead of "I'm terrible at this," try, "This loss is a learning opportunity. I'm improving." Over time, these statements reshape your mindset and improve your performance. Discipline is the backbone of trading success. Discipline means doing what you need to do even when you don't feel like it. It means sticking to your rules, respecting your stops, following your plan, and resisting the urge to chase or revenge trade. Discipline is often confused with willpower. Willpower is limited and can get exhausted during stressful times. Discipline is built through habits and systems that make good behavior automatic. One way to build discipline is by developing rituals, consistent habits that prepare your mind for trading. This could be reviewing your journal every morning, setting up your charts the same way every day, or taking a few minutes of deep breathing before trading. These rituals act like anchors. They shift you into a focused state where discipline feels natural, not forced. Journaling is one of the most powerful tools to master the inner game. A trading journal isn't just a record of your trades. It's a mirror reflecting your mindset, emotions, and behaviors. By journaling every trade's rationale, outcome, and your emotional state, you gain clarity about what works and what doesn't, not just in your system, but in your psychology. Many traders make the mistake of ignoring their mental game. They focus on technical analysis but neglect the emotional side. But consistent journaling helps identify patterns like revenge trading, fear exits, or overtrading. When you spot these patterns, you can take corrective action and grow. Let's talk about mental conditioning, training your brain like an athlete trains their body. Just as physical fitness requires consistent exercise, mental toughness in trading requires regular practice. Visualization is a powerful tool here. Before trading, imagine yourself executing your plan perfectly. Visualize handling losses calmly. Imagine walking away from the screen after a bad day without chasing losses. This mental rehearsal builds neural pathways that make those positive behaviors more natural when you're actually trading. Meditation and mindfulness also help by increasing your awareness of emotional triggers and reducing impulsive reactions. One mental framework that has helped many traders is the idea of detachment. Detachment doesn't mean being cold or indifferent. It means observing your trades without getting emotionally hooked to the outcome. Think about it like watching a movie. You're involved in the story, but you know it's not real life. You enjoy the experience, but don't let it shake you. Practicing detachment helps reduce the highs of winning and the lows of losing. It allows you to stay balanced and clear-headed, so you can execute your plan consistently. Another key mindset shift is to see losses as feedback, not failure. Every loss teaches you something. It's not a judgment on your worth or skill, but data about your system and your behavior. When you treat losses as learning opportunities, you stop fearing them. You become curious and grow. This mindset reduces emotional pain and builds resilience. Building a strong trading identity is the foundation for mastering the inner game. Ask yourself, who am I as a trader? What kind of trader do I want to be? When you define your trading identity, disciplined, patient, systematic, resilient, you create a mental blueprint that guides your actions. Identity is more powerful than goals. Goals can be missed or changed, but identity shapes how you think and behave consistently. Finally, remember this: trading is a lifelong journey of self-discovery. You will face setbacks, doubts, and frustrations, but each challenge is an opportunity to grow stronger. When you master the inner game, you become more than a trader. You become a master of your mind.